Invest like a pro, even if you're a total beginner. Written by Ronnie Rowland. Published by Growth Literacy Lounge. What if you could take control of your financial future, even if the idea of investing feels as foreign as speaking another language? Imagine building wealth without needing to be a financial expert or spending hours glued to stock market charts. This book isn't about complicated formulas or insider secrets. It's about showing you, step by step, how to invest like a pro, even if you're starting with zero experience. Your journey toward financial freedom begins here. Every Thursday evening, Mia found herself in the same spot, sprawled on the couch after a long day of work, watching videos about people who had turned small investments into thriving portfolios. She'd hear words like diversification and compounding interest and wonder if they were speaking another language. But what struck her most wasn't the technical terms, it was the possibility. These weren't Wall Street tycoons or tech billionaires. They were ordinary people, a nurse who started investing $50 a month, a college grad who turned her coffee budget into an investment portfolio, a single dad securing his kid's future. Mia couldn't help but wonder, why not me? She thought about her own situation. At 28, she had a steady job, some savings, and big dreams of traveling, buying a home, and one day retiring early. But every time she thought about investing, she felt stuck. The fear of losing money and the complexity of the process loomed large. She had no idea where to start, or if starting was even possible for someone like her. That Thursday, something shifted. She wasn't content to keep waiting for someday. She decided she'd take a leap. The next morning, Mia bought her first investment, a single share in an index fund. It wasn't much, but it was a start. As the days turned into weeks, she realized something powerful. Investing wasn't as intimidating as she thought. All she needed was the right mindset, a bit of guidance, and the courage to begin. Like Mia, you may be feeling the pull toward investing but don't know where to begin. Maybe you've always thought investing was only for the wealthy or the highly educated. Maybe you're overwhelmed by the conflicting advice on the internet or afraid of making costly mistakes. Or perhaps you've tried investing before, only to feel more confused than when you started. You'll learn how to start small and grow your portfolio over time, even if you have no prior experience. Avoid common beginner mistakes that cost people money and confidence. Build a simple, steady investment plan that aligns with your goals and risk tolerance. Understand key concepts like diversification, compounding, and asset allocation without the headache. Every successful investor began somewhere, and this is your starting point. The road ahead isn't complicated, it's clear, actionable, and designed just for you, the beginner. So take a deep breath, turn the page, and get ready to take your first step toward investing like a pro. Your future self will thank you. Let's begin. Chapter 1. The Myth of the Expert Investor. Did you know that the average investor earns returns that are 3% lower than the market's average annually? This seemingly small gap could cost them hundreds of thousands of dollars over their lifetime. What's behind this shocking disparity? The world of investing often feels like an exclusive club reserved for the financially elite or the academically gifted. Many believe that success in investing demands years of experience, advanced degrees, or the ability to analyze complex charts filled with zigzagging lines. This myth has discouraged millions of everyday individuals from stepping into the world of wealth building, convinced they lack the expertise to thrive. But what if I told you that the secret to investing success is not about being a financial guru? It's not about timing the market perfectly, finding the next Apple or Amazon, or even memorizing endless jargon. The reality is that most professional investors fail to outperform simple strategies that anyone can follow. Yes, even with their insider knowledge and advanced algorithms, they often come up short. This isn't just a fluke, it's a pattern. To uncover the truth, let's dismantle the myth of the expert investor. Imagine two individuals, one is a highly educated financial analyst working for a prestigious firm, and the other is an average office worker with no formal training in finance. Who would you expect to perform better in the stock market over a decade? Most would confidently bet on the professional. Yet studies consistently show that the average office worker, armed with basic knowledge and disciplined habits, can often outpace the returns of even seasoned professionals. Here's the dirty little secret of the financial world: expertise doesn't guarantee success. Professionals face immense pressure to justify their fees, leading them to overtrade, chase fleeting trends, or overcomplicate their strategies. their constant need to beat the market becomes their Achilles heel, exposing them to higher risks and, ironically, lower returns. Contrast this with someone who sticks to a simple, tried-and-true strategy like investing in index funds. By avoiding the pitfalls of overconfidence and sticking to a steady plan, they benefit from the market's natural growth over time. Take the story of Sarah, a nurse with no formal education in finance. At 30, she decided to start investing a small percentage of her income in a low-cost index fund. Sarah didn't try to pick individual stocks, nor did she worry about market fluctuations. Instead, she committed to investing a fixed amount every month, rain or shine. Meanwhile, her colleague Mark, a finance enthusiast, spent countless hours researching stocks, watching CNBC, and tweaking his portfolio. After 20 years, who came out ahead? Sarah did, with significantly higher returns, even though Mark's approach seemed more professional. Why? Sarah avoided common mistakes that stem from emotional reactions and overthinking. Her strategy capitalized on consistency and time, while Mark's attempts to outsmart the market led to unnecessary risks. Research backs up Sarah's experience. According to a study by Dalbar, over the past 30 years, the average investor earned just 2.6% annually, while the S&P 500 returned around 10%. Why the gap? Behavioral mistakes, poor timing, and overcomplicated strategies are the main culprits. These mistakes aren't exclusive to amateurs. Professionals fall prey to them too. The myth of the expert investor is not just false, it's harmful. It creates an unnecessary barrier to entry, making everyday individuals feel like they don't belong in the world of investing. It also fosters a dangerous reliance on so-called experts, many of whom are more interested in their own profits than yours. But here's the empowering truth: you don't need to be an expert to succeed. Investing is less about intelligence or experience and more about consistency, patience, and sticking to simple principles. By understanding this, you can unlock the door to financial freedom and confidently take charge of your future. Picture the stock market as a vast ocean. Professional investors often act like fishermen trying to catch the rarest, most exotic fish. It's risky, time-consuming, and only occasionally successful. On the other hand, everyday investors can think of themselves as tide watchers. They don't need to know the intricacies of each wave, they just need to trust that the tide will rise over time and position themselves accordingly. By focusing on the bigger picture, you can avoid the traps of overcomplication and enjoy the long-term growth that the market naturally provides. The belief that investing requires professional expertise is a myth. Success is accessible to anyone willing to adopt simple, consistent strategies. Chapter 2. The biggest myths about investing. You need to be rich to start investing. You'll lose all your money in the next crash. Investing is just gambling. How many of these statements have you heard? What if I told you that every single one of them is wrong, and holding on to these beliefs could cost you your financial future? Fear, uncertainty, and doubt. These are the invisible walls that keep people from stepping into the world of investing. For decades, myths and misconceptions have circulated about what it takes to succeed as an investor. These falsehoods serve as convenient excuses for inaction, and worse, they fuel anxiety that paralyzes even the most capable individuals. Myth 1. You need a lot of money to start. This is one of the most pervasive myths. The idea that you need thousands, or even tens of thousands of dollars to begin investing is not only outdated but entirely inaccurate. Technology and innovation have democratized the world of investing. Thanks to apps and platforms like Robinhood, Acorns, and Fidelity, you can start investing with as little as $1. Take Jake, for instance. At 22, fresh out of college and saddled with student debt, he decided to invest just $50 a month into an index fund. It didn't seem like much, but over the years, as his salary grew, he increased his contributions. By the time he reached 40, Jake's portfolio was worth over $200,000, thanks to the magic of compounding interest. If he'd waited until he had enough money, he would have missed out on the most valuable asset in investing: time. Myth 2. Investing is too risky. Yes, the market has its ups and downs, but is it risky? Only if you don't have a plan. People who view investing as a gamble usually lack an understanding of the principles that mitigate risk. These include diversification, dollar-cost averaging, and aligning investments with personal goals. Think of investing as crossing a river. Without preparation, you might slip and fall. But with stepping stones, like a diversified portfolio, long-term strategy, and emergency savings, you can navigate safely to the other side. The real risk isn't in the market itself, it's in failing to act. Data supports this. Over any 20-year period in the past century, the U.S. stock market has delivered positive returns. In other words, investing for the long term isn't just smart, it's statistically in your favor. Myth 3. You need to be an expert. Imagine you're planning a trip. Do you need to be a certified mechanic to drive your car? Of course not. Similarly, you don't need to be a financial expert to invest successfully. In fact, many professionals make poor decisions because they overcomplicate things. Simple strategies like investing in broad market index funds, automating contributions, and avoiding emotional decisions outperform even complex hands-on approaches. The key isn't expertise, it's discipline. Myth 4. The market is a rigged game. Conspiracy theories abound about Wall Street being rigged against small investors. While the market isn't perfect, it's not as insidious as many believe. The democratization of financial tools and information has leveled the playing field significantly. The real challenge isn't corruption, it's behavior. Overtrading, panic selling, and chasing trends are what derail most investors. Avoid these, and you'll already be ahead of the pack. Myth 5. Investing is gambling. Here's a simple distinction. Gambling is placing a bet based on chance. Investing is placing a bet based on evidence and strategy. Yes, there's an element of uncertainty, but with research, diversification, and time, you can dramatically increase your odds of success. Unlike a casino, the stock market is designed to grow over time. The longer you stay in the market, the higher your likelihood of winning. These misconceptions persist because they're easy to believe. They let us off the hook, giving us a reason to delay or avoid investing altogether. But breaking free from these lies is liberating. It opens the door to financial empowerment and stability. Here's a question to ask yourself. What has believing these myths cost you so far? Could you have started sooner, invested more confidently, or built more wealth if you hadn't fallen for these falsehoods? The biggest barrier to investing is not money or knowledge, it's belief in harmful myths. By rejecting these misconceptions, anyone can start their investment journey with confidence. Chapter 3. The Power of Consistency over Expertise. What if I told you that the secret to building wealth isn't about timing the market or picking the next hot stock? It's about something far simpler: showing up, again and again, with consistency. Everywhere you look, people seem to celebrate the bold and dramatic. Stories about investors who struck gold by buying at the exact right moment or discovering a hidden gem stock dominate headlines. But for every one of these rare success stories, there are thousands of investors quietly building wealth, not with dramatic moves but with steady, consistent action. Let's start by addressing a fundamental misconception. Many people think expertise is the golden ticket to investment success. They picture seasoned analysts poring over charts, making rapid trades, and executing brilliant strategies. But as studies show, even professionals struggle to consistently beat the market. What truly matters is behavior, specifically, the ability to stick with a plan regardless of what the market is doing. Consistency trumps expertise because it allows you to benefit from one of the most powerful forces in finance: compounding. Imagine a snowball rolling down a hill. At first it's small and unimpressive. But as it picks up snow, it grows exponentially, eventually becoming an unstoppable force. That's how compounding works in investing. Consider Emily, a schoolteacher who began investing $200 a month in an S&P 500 index fund at age 25. Over the decades, she rarely thought about her investments. She simply automated her contributions and stayed the course, even during recessions and market crashes. By the time she turned 65, Emily's portfolio was worth over $1.5 million. Her secret: consistency. She didn't try to predict market swings or outthink professional traders. She simply committed to her plan and let time do the heavy lifting. Why consistency works. 1. It reduces emotional decisions. The market will inevitably go through ups and downs. Many investors panic during downturns and sell low, only to buy back when prices have already risen. Consistency removes emotion from the equation. By sticking to a regular schedule, you're less likely to make impulsive decisions that hurt your returns. 2. It capitalizes on dollar-cost averaging. By investing the same amount regularly, you buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy lowers the average cost of your investments, boosting your returns. 3. It builds momentum. Investing consistently creates a habit. Like brushing your teeth or exercising, the more you do it, the more natural it feels. This momentum makes it easier to stay committed, even when the market feels unpredictable. Let's face it, most of us aren't going to spend hours analyzing financial statements or predicting economic trends. The good news is we don't have to. Tools like index funds and ETFs, exchange-traded funds, were designed for people who want a simple, hands-off way to invest. John Bogle, the founder of Vanguard and a pioneer of index funds, once said, "Don't look for the needle in the haystack. Just buy the haystack." His advice underscores a key truth: rather than chasing individual stock performance, you can achieve consistent, strong returns by owning the entire market. Index funds are the ultimate tool for consistency, allowing you to invest broadly and let the market's natural growth fuel your wealth over time. Consistency's secret weapon is time. The earlier you start and the more consistent you are, the greater the rewards. Take two hypothetical investors. Investor A starts investing $5,000 annually at age 25, but stops contributing after 10 years. Investor B starts investing $5,000 annually at age 35, and continues until retirement at 65. Even though Investor A only invested for a decade, they end up with more money than Investor B. Why? Because the extra 10 years of compounding growth make a massive difference. This isn't about who's smarter or more skilled, it's about the simple power of starting early and being consistent. How to get started with consistency. 1. Automate your investments. Set up automatic contributions to your investment account. This removes the need for constant decision-making and ensures you stay consistent. 2. Set realistic goals. Start with what you can afford, even if it's just $50 a month. Consistency matters more than the amount. 3. Ignore the noise. The media thrives on sensational headlines, but successful investors stay focused on their plan. Turn off the noise and trust the process. 4. Think long-term. Remember, investing is a marathon, not a sprint. Consistency rewards those who stick around for the long haul. Consistency might not sound glamorous, but it's the cornerstone of financial success. By committing to regular contributions and avoiding the temptation to chase the market, you can achieve results that outperform even the savviest experts. When you take a step back, it becomes clear: the real magic isn't in making one perfect move. It's in showing up, day after day, year after year. Expertise is overrated. Consistency, combined with the power of time, is the true driver of investment success. Chapter 4. Tools of the Trade. Simplifying your strategy. Imagine if you could set up an investment plan in under 30 minutes that could potentially make you a millionaire. No spreadsheets, no market predictions, no headaches, just simple tools working in your favor. Investing doesn't have to be complicated. In fact, the more you simplify your strategy, the better your chances of success. Most mistakes in investing stem from overthinking and trying to outsmart the market. But here's the good news: you don't need to be a genius to build wealth. All you need are a few straightforward tools and the discipline to use them consistently. Let's dive into the most powerful tools available to everyday investors and how they can make your life easier while maximizing your returns. Tool 1. Dollar cost averaging. Dollar cost averaging (DCA) is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. It's the ultimate equalizer, ensuring you don't need to worry about timing the market. Take the example of Alex, who started investing $200 a month into an index fund. When the market was down, Alex's fixed contribution bought more shares. When the market was up, it bought fewer. Over time, this steady approach reduced Alex's average cost per share and eliminated the stress of deciding when to invest. Why DCA works: it removes emotion from the equation. It capitalizes on market dips, turning volatility into opportunity. It's easy to automate, making consistency effortless. Tool 2. Index funds and ETFs. If there's a single must-have tool in your investment arsenal, it's the index fund or ETF, exchange-traded fund. These funds pool money from multiple investors to buy a diversified portfolio of stocks or bonds. Instead of betting on individual companies, you're essentially betting on the entire market's long-term growth. Here's why they're so effective. Low fees. Index funds typically have much lower fees compared to actively managed funds. Diversification. By investing in hundreds or thousands of companies, you reduce your risk, proven performance. Over time, broad market index funds like the S&P 500 consistently outperform most actively managed funds. John, a 35-year-old graphic designer, started investing in an S&P 500 index fund with just $100 a month. He didn't pick stocks, follow market news obsessively, or try to outguess trends. By the time he turned 50, his account had grown to over $100,000, all thanks to the consistent returns of his index fund. Tool 3. Compound interest. Compound interest is your silent wealth-building partner. Think of it as earning interest on both your initial investment and the interest that your money generates over time. The earlier you start investing, the more compounding works in your favor. Imagine two friends. Sarah starts investing $5,000 a year at age 25 and stops at 35. Emily starts investing $5,000 a year at age 35 and continues until 65. Even though Emily invests for 30 years while Sarah invests for just 10, Sarah ends up with more money. Why? Because the early start gave her investments more time to compound. Tool 4. Automation. The simplest way to ensure you stay consistent with your investing strategy is to automate it. Most brokerages and investment apps allow you to set up automatic contributions, so a portion of your paycheck goes directly into your investment account. This approach ensures you never miss a month and eliminates the temptation to spend money earmarked for your future. Here's a quick start guide for putting these tools to work. 1. Choose a platform. Select a reputable brokerage or app that offers low-cost index funds or ETFs. 2. Set your contribution. Decide how much you can invest each month. Even $50 is enough to get started. 3. Automate your plan. Set up recurring transfers to your investment account. 4. Pick a fund. Start with a broad market index fund like the S&P 500 or a total market fund. 5. Forget the rest. Avoid obsessing over market news. Stick to your plan and let time do its work. The beauty of these tools is their simplicity. They don't require hours of research or advanced knowledge, and they protect you from making costly mistakes. Investing is like planting a garden. You don't need to obsess over every seed you plant, you just need to water them consistently and let nature take its course. The right tools, dollar cost averaging, index funds, compound interest, and automation, make investing simple and accessible to anyone. You don't need to be a financial expert, you just need to start. Chapter 5. The Psychology of a Winning Investor. Why do so many investors make the same mistakes over and over again? It's not a lack of knowledge, it's the battle in their own minds. What if mastering your emotions could be the key to winning the investment game? Investing isn't just about numbers, charts, or strategies, it's about managing emotions. Fear, greed, impatience, and overconfidence can sabotage even the most well-thought-out plans. Behavioral finance, a field that studies how psychology impacts financial decisions, reveals that our minds often work against us when it comes to investing. Let's break down the psychological pitfalls that derail most investors and explore how you can train your mind to stay the course. The stock market is volatile. Prices rise and fall, sometimes dramatically. During a downturn, fear takes over. Headlines scream about market crashes, retirement savings vanishing, and impending recessions. The natural instinct? Sell everything and run for safety. But here's the irony: selling during a downturn locks in losses. Historically, markets recover over time. By selling out of fear, you miss out on the rebound and the subsequent growth. Consider this. In March 2020, at the height of pandemic panic, markets plummeted. Many investors sold their positions, fearing further losses. Yet, within months, the market staged one of its fastest recoveries in history. Those who stayed invested reaped the benefits, while panic sellers faced regret. On the flip side of fear is greed. This psychological trap often manifests as FOMO, fear of missing out. When a stock or sector experiences a surge, the media buzzes, and everyone seems to be making money, except you. The temptation? Jump in at the peak, hoping for quick gains. Take the Bitcoin frenzy in late 2017. Prices skyrocketed, drawing in countless investors eager for a piece of the action. But by 2018, Bitcoin's value plummeted, wiping out much of those gains. The lesson? Chasing trends rarely ends well. Investing should be about long-term value, not short-term hype. One of the most pervasive psychological traps is believing you can time the market, selling at the peak and buying at the bottom. Studies repeatedly show that even professional investors fail at this consistently. For everyday investors, it's a recipe for stress and disappointment. A better approach: adopt a time in the market mindset rather than trying to predict timing the market. Historically, the longer you stay invested, the more likely you are to see positive returns. The most successful investors aren't those with the best strategies, they're the ones with the best discipline. Warren Buffett, one of the world's most celebrated investors, attributes much of his success to controlling his emotions. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." But how do you build emotional discipline? Here are some practical tips. 1. Know your why. Investing is a means to an end. Whether it's retirement, buying a home, or financial freedom, having a clear goal keeps you focused during turbulent times. 2. Have a plan. A written investment plan acts as your roadmap, reminding you of your long-term strategy when emotions run high. Include specifics like how much you'll invest, your allocation, and when you'll rebalance. 3. Automate your decisions. Automating contributions and rebalancing removes the temptation to make impulsive decisions. 4. Embrace diversification. Diversification spreads your risk, reducing the emotional impact of any single investment's performance. 5. Detach from market noise. The 24/7 news cycle thrives on fear and excitement, but successful investors know how to tune it out. Instead of fearing market volatility, see it as an opportunity. When prices drop, you're essentially getting investments on sale. Dollar cost averaging ensures that you naturally buy more during downturns, setting you up for greater gains when the market recovers. Patience is perhaps the hardest psychological skill to master. Humans are wired for instant gratification, but investing rewards those who think long-term. Imagine planting a tree. You wouldn't dig it up every week to check its roots, you trust that, with time, it will grow tall and strong. The same applies to your portfolio. A powerful example of patience in action is the story of Grace Groner, a secretary who lived frugally and invested small amounts in stocks throughout her life. By the time she passed away, her modest investments had grown to over $7 million, all because she allowed time and compounding to work their magic. When you learn to master your emotions, you gain a massive advantage over other investors. Staying calm during downturns, avoiding the temptation to chase trends, and focusing on your long-term goals are what separate successful investors from the rest. The market will test your resolve, but with the right mindset, you can navigate it confidently. Winning at investing isn't just about strategy, it's about mastering your psychology. Emotional discipline, patience, and a long-term perspective are the keys to financial success. Chapter 6. Avoiding the pitfalls that derail most investors. Did you know that the average investor loses over a quarter of their potential returns due to avoidable mistakes? What if you could sidestep the traps that derail most people and maximize your wealth with ease? Investing is deceptively simple in theory: buy low, sell high, and stay consistent. Yet, in practice, countless investors sabotage themselves through avoidable errors. These pitfalls aren't just the domain of beginners, even seasoned professionals fall prey to them. The key to long-term success is recognizing these traps and learning how to avoid them. Pitfall 1. Overtrading. One of the most common mistakes investors make is overtrading, buying and selling too frequently in the hope of capturing short-term gains. The problem? Each trade comes with costs, from transaction fees to taxes, and these can eat into your returns. Take Michael, a young investor who believed he could outsmart the market by constantly shifting his portfolio. Over 3 years he made dozens of trades, incurring significant fees and often buying high and selling low. When he compared his returns to a friend who simply stuck with an index fund, Michael realized he had underperformed by nearly 20%. Solution: stick to a long-term strategy and avoid frequent trading. Let your investments grow without constant tinkering. Pitfall 2. Timing the market. The allure of timing the market, buying at the lowest point and selling at the highest, is strong. But the reality is that even professionals can't predict market movements with consistency. Trying to time the market often leads to missed opportunities and emotional decision-making. Consider this. If you had missed just the 10 best days in the market over the past 20 years, your returns would have been cut in half. The cost of sitting out during rebounds far outweighs any potential gains from perfect timing. Solution: focus on time in the market, not timing the market. Stay invested and trust the process. Pitfall 3. Ignoring fees. Investment fees might seem insignificant, but they add up over time. A 1% annual fee might not sound like much, but over 30 years, it can reduce your total returns by nearly 25%. That's a quarter of your potential wealth gone. Solution: opt for low-cost investment options like index funds and ETFs. Be vigilant about expense ratios and hidden fees. Pitfall 4. Letting emotions take control. Investing is an emotional roller coaster. Fear during downturns and greed during upswings can lead to poor decisions. Many investors panic sell during crashes, locking in losses, or chase rising stocks, buying at inflated prices. Remember the 2008 financial crisis? Millions of investors sold their holdings at rock-bottom prices, fearing further losses. Those who stayed invested, however, saw their portfolios recover and grow significantly in the years that followed. Solution: create a plan and stick to it. Automation can help remove emotions from the equation. Pitfall 5. Chasing hot tips. The idea of getting rich quickly through a hot stock tip is incredibly enticing. However, most hot tips are speculative and rarely deliver long-term value. By chasing trends, you expose yourself to unnecessary risks. Take the GameStop saga in 2021. While some investors made fortunes, many others jumped in late, buying at inflated prices and suffering massive losses when the bubble burst. Solution: rely on a diversified long-term strategy rather than speculation. Pitfall 6. Lack of diversification. Putting all your eggs in one basket, whether it's a single stock or sector, can spell disaster. Even the most promising companies can face unforeseen challenges, and without diversification, your entire portfolio is at risk. Solution: spread your investments across different asset classes, industries, and geographic regions. Diversification minimizes risk and smooths out returns. Pitfall 7. Neglecting rebalancing. Over time, your portfolio's allocation can drift as some investments outperform others. This imbalance can expose you to more risk than you intended. For example, if stocks perform well, they may take up a larger portion of your portfolio, leaving you vulnerable during a downturn. Solution: periodically rebalance your portfolio to maintain your desired allocation. Many brokerages offer tools to automate this process. Pitfall 8. Giving up too soon. Investing is a long-term game, but many people quit when they don't see immediate results. Impatience can lead to abandoning strategies that would have worked given enough time. Take Ashley, who invested in a total market index fund but grew frustrated after 2 years of flat returns. She sold her holdings only to watch the market surge over the next 5 years. Her mistake? Expecting instant gratification in a system built for long-term rewards. Solution: embrace the mindset of patience and trust in the process of compounding growth. Turning pitfalls into opportunities. Recognizing these traps is the first step to avoiding them. Investing isn't about being perfect, it's about minimizing mistakes and staying the course. By avoiding common pitfalls, you can set yourself apart from the majority of investors and keep more of your hard-earned returns. Most investors fail not because they lack knowledge, but because they fall into avoidable traps. By recognizing and sidestepping these pitfalls, you can dramatically improve your financial outcomes. Chapter 7. The Secret Sauce. Time in the market, not timing the market. If you could predict the future, investing would be easy. But here's the good news: you don't have to predict anything to succeed. The secret to building wealth is not timing the market, it's time in the market. Picture this: the market dips, and you think, this is the perfect time to buy. Or prices soar, and you rush to sell before the bubble bursts. It sounds logical, even smart. But studies show that timing the market is nearly impossible to do consistently. Even professionals with advanced tools and years of experience get it wrong. Here's a startling statistic. If you had missed the 10 best trading days in the market over the last 20 years, your returns would have been cut in half. Missing the best 30 days? Your returns would shrink to a fraction of what you could have earned. The cost of sitting out is far greater than the benefits of trying to time the perfect entry or exit. The stock market is a lot like a garden. Seeds don't sprout overnight, they grow slowly, steadily, and with care. Investing works the same way. Time allows your investments to grow through the power of compounding. a process where your earnings generate their own earnings. Take two friends, Alice and Bob. Alice starts investing $5,000 a year at age 25 but stops after 10 years. Bob starts investing $5,000 a year at age 35 and continues until he's 65. Who ends up with more money? Surprisingly, it's Alice. Even though she invested for only 10 years, her early start gave her more time to compound, leading to greater wealth than Bob, who invested for 30 years. The lesson? Starting early and staying invested is far more powerful than trying to time the market. Albert Einstein called compound interest the eighth wonder of the world, and for good reason. Here's how it works. In year 1, your $1,000 investment grows 10% to $1,100. In year 2, you earn 10% on $1,100, not just your original $1,000. By year 3, your returns build on top of returns, creating exponential growth. The longer you stay in the market, the more dramatic this compounding effect becomes. Time isn't just money, it's the key to unlocking exponential wealth. Market downturns often scare investors into pulling out their money. But these dips are temporary. Historically, the market has always recovered and continued its upward trend. Let's consider the financial crisis of 2008. The S&P 500 lost nearly 40% that year, causing widespread panic. Many investors sold their holdings, convinced that the market would never recover. But those who stayed invested saw their portfolios bounce back within a few years. By 2020, the market had more than tripled from its 2008 lows. On the flip side, those who pulled out and waited for the right time to re-enter missed out on the recovery. Sitting on the sidelines often leads to missed opportunities. The stock market rewards patience. Over any 20-year period in history, the U.S. market has always delivered positive returns. While short-term fluctuations can be nerve-wracking, the long-term trend is unmistakable: the market grows. To illustrate this, consider the following example. If you invested $10,000 in the S&P 500 in 1980, your investment would be worth over $700,000 today, assuming you reinvested dividends and stayed the course. If you tried to time the market and missed key growth periods, your returns would be a fraction of this. The takeaway? The more you focus on the big picture, the less the daily ups and downs matter. How to stay invested. 1. Create an investment plan. Define your goals, time horizon, and risk tolerance. A clear plan helps you stay committed, even during volatile times. 2. Automate your contributions. Regular, automated investments keep you on track and prevent emotional decision-making. 3. Diversify your portfolio. Spreading your investments across asset classes and sectors reduces risk and ensures smoother returns. 4. Ignore the noise. Headlines are designed to grab attention, not guide sound investment decisions. Turn off the news and trust your strategy. 5. Remember your why. Whether it's retirement, a home, or financial independence, keeping your end goal in mind will help you weather short-term storms. Investing isn't about quick wins, it's about lasting success. By prioritizing time in the market over timing the market, you can harness the steady growth of the market to build life-changing wealth. The secret isn't finding the next big stock or beating the pros, it's staying the course, no matter what. When you shift your focus from short-term gains to long-term growth, you transform the way you invest. Instead of reacting to market fluctuations, you start to see them as part of a larger, predictable pattern. Over time, this perspective will not only protect your wealth but help it thrive. Time in the market, not timing the market, is the single most powerful factor in building lasting wealth. Start early, stay consistent, and trust the process. Chapter 8. Your Roadmap to Financial Independence. Imagine a life where money is no longer a worry, where your days are yours to spend as you wish, pursuing your passions, traveling the world, or simply enjoying time with loved ones. Financial independence isn't a fantasy, it's a destination you can reach with the right plan and determination. Financial independence is about more than money. It's about freedom to make choices without the constraints of a paycheck. For some, it means retiring early. For others, it's pursuing a dream or building a life focused on what matters most. Whatever your vision, the journey to financial independence begins with a clear plan and consistent action. Let's build your roadmap together. Step 1. Define your financial independence number. The first step is knowing your destination. How much do you need to live comfortably without worrying about income? This number will vary depending on your lifestyle, but the 4% rule offers a good starting point. Multiply your annual expenses by 25. For example, if you need $50,000 per year, your target is $1.25 million. This isn't just a number, it's your goalpost, the figure that represents your financial freedom. Step 2. Assess where you are now. Before you can plan your route, you need to know your starting point. Take stock of savings. How much have you already set aside? Investments. What's your current portfolio worth? Debt. Are there high-interest loans holding you back? Monthly cash flow. How much are you saving or spending each month? This financial snapshot will guide your next steps. Step 3. Build your financial safety net. Achieving financial independence requires a solid foundation. Without one, unexpected events can derail your progress. Start with emergency fund. Save 3 to 6 months of living expenses in a high-yield savings account. This buffer protects you from dipping into your investments for emergencies. Debt repayment. Eliminate high-interest debt, such as credit cards. These liabilities can erode wealth faster than you can build it. Once your foundation is secure, you're ready to focus on growth. Step 4. Automate and simplify your investments. Automation is the secret weapon of successful investors. By setting up automatic contributions to your investment accounts, you remove emotion from the equation and ensure consistent progress toward your goals. Here's how to simplify your investment strategy. 1. Invest in index funds or ETFs. These low-cost options offer diversification and reliable returns over the long term. 2. Use dollar cost averaging. Invest a fixed amount regularly to reduce the risk of market volatility. 3. Rebalance annually. Adjust your portfolio to maintain your target asset allocation. These steps ensure your investments work for you, not the other way around. Step 5. Save aggressively and increase your income. The more you save and invest, the faster you'll reach financial independence. Look for ways to cut unnecessary expenses without sacrificing your quality of life. Simultaneously, explore opportunities to grow your income, such as negotiating raises at work, starting a side hustle, upskilling, or pursuing higher-paying roles in your field. Remember, every dollar saved or earned is a step closer to your goal. Step 6. Stay consistent and avoid pitfalls. The journey to financial independence is long, and it's easy to get sidetracked. Market volatility, lifestyle inflation, or impatience can derail your progress if you're not careful. Here's how to stay on course. Ignore market noise. Focus on your long-term goals rather than reacting to short-term fluctuations. Live below your means. Avoid lifestyle creep by prioritizing savings over unnecessary upgrades. Celebrate progress. Break your journey into smaller milestones and reward yourself along the way to stay motivated. Step 7. Embrace the long-term perspective. Financial independence isn't an overnight success story. It's a slow, steady climb that rewards patience. The power of compounding means your progress accelerates over time, so staying invested and consistent is crucial. Take Grace, for example. A school librarian, she began investing $200 a month at age 25. She stayed the course through recessions, market crashes, and personal challenges. By age 65, Grace had a portfolio worth over $1.5 million, not because of luck, but because of time and consistency. Step 8. Reaching financial independence. When you achieve your financial independence number, the journey doesn't end, it transforms. You gain the freedom to choose how you spend your time. Whether it's retiring early, pursuing a passion project, or working part-time on something you love, the key is knowing that work is now a choice, not a necessity. Here's a streamlined version of the steps. 1. Set your financial independence goal. Use the 4% rule to calculate your target. 2. Assess your finances. Identify your starting point and build a safety net. 3. Automate and invest. Focus on low-cost, diversified investments with consistent contributions. 4. Save and earn more. Maximize your income and redirect excess funds toward your goal. 5. Stay the course. Avoid emotional decisions and celebrate milestones. With these steps, financial independence becomes less intimidating and more achievable. Financial independence isn't just about escaping financial stress, it's about gaining control over your life. It's about saying yes to the things that matter and no to the things that don't. With a clear roadmap, disciplined action, and the lessons you've learned throughout this book, you're well equipped to turn your dreams into reality. Remember, the journey starts today. No matter where you're starting from, every step brings you closer to the life you envision. Now, take that first step and don't look back. Financial independence is a realistic, achievable goal with the right plan, consistent effort, and long-term mindset. Follow this roadmap, and you'll be on your way to a life of freedom and purpose. Final words. You've reached the end of this book, but the beginning of something far greater, your journey to financial independence. Along the way, you've uncovered the tools, strategies, and mindset shifts that will guide you to build wealth with confidence and purpose. Remember, success in investing isn't about being the smartest person in the room or making the boldest moves. It's about showing up consistently, staying the course, and trusting the process. You don't need to know everything to get started, you just need to take the first step. The road to financial independence is paved with intention and persistence. There will be moments of doubt, challenges to overcome, and temptations to veer off track, but with each small action you're planting seeds for a future where you control your time, choices, and destiny. This journey is yours. Make it count. Start today, stay committed, and watch as your vision transforms into reality. Your future self is waiting, ready to live the life you've always imagined. Now go and invest in the life you deserve. Take care and be well.